Chapter 15, Public Revenue and Expenditure. Public revenue is the income of the government through all its sources in a certain period. Taxes are important sources of public revenue. Public expenditure is the expenditure incurred by public authorities for promoting their economic and social welfare. Public revenue. Public revenue is an important concept of public finance. It refers to the income of the government from different sources. Public revenue includes income from taxes and goods and services of public enterprises, revenue from administrative activities such as fees, fines, etc. In other words, government expends money for development and welfare activities. The expenditure on food, education, health, infrastructure, urbanization, etc. is increasing day by day. To meet these expenses, the government mobilizes income from various sources. The study of the income and expenditure of the government is covered under the purview of public finance. According to Dalton, public finance is a concern with the income and the expenditure of public authorities and with the adjustment of the one with the other. According to Herod Groves, public finance is a field of inquiry that treats the income and outgoes of government and federal, states, and local. Under the theory of public finance, we study alternative sources of state income. It discusses and analyzes comparative advantage and disadvantage of various forms of revenue and the principles which should govern the choice between them. Sources of public revenue can be divided into two parts, which are as follows. Earned revenue. It is the kind of revenue which is received from certain assured sources kept under the complete disposal of governmental ownership. It includes public domain like rent, royalties, sales of forest products, etc., and commercial revenues like profits of public sector enterprises, public utility services, etc. Earned revenue. It is that revenue which is mobilized by the government without any contractual obligations to the pay. It includes taxes, fines, and forfeitures, special assessment levies, estates, gifts, and grants, etc. Sources of public revenue can also be classified into tax and non-tax revenue. Trends and receipts. Capital receipts. Capital receipts are the amounts received in the form of additional capital introduced, loans received and sale, proceeds of the fixed assets. Capital receipts either increase the liabilities or reduce the assets. Revenue receipts. These receipts neither increase the liabilities nor decrease the assets. These can be further classified as tax receipts and non-tax receipts. An important feature of the revenue receipts is that the amount received does not need to be returned to anyone. All such receipts are revenue receipts and are treated as income. Hence, these are shown on the credit side of the profit and loss account. Tax revenue. Tax is a compulsory payment by the citizens to the government to meet the public expenditure. It is legally imposed by the government on the taxpayer, and in no case taxpayer can deny to pay taxes to the government. According to Dalton, a tax is a compulsory contribution imposed by the public authority irrespective of the exact amount of service to the taxpayer in return and not imposed as a penalty for any legal offense. Characteristics of taxes. It is a compulsory payment. It is levied by lawmaking body. It is proportionate in character. It is generally payable in money. There is no direct quid pro quo involved in the payment of taxes. Classification of taxes. The taxes can be classified in the following manner: direct and indirect taxes, proportionate, progressive, and non progressive taxes. Direct taxes. The direct tax is that which is borne by the person on whom it is levied. The burden of direct tax cannot be shifted to other person. Impact of the tax as well as incidence of the tax is on the same person. According to Dalton, a direct tax is really paid by a person on whom it is legally imposed, while an indirect tax is imposed on one person but paid partially or wholly by another, owing to consequential change in the terms of some contract or bargaining between them. According to J.S. Mill, a direct tax is one demanded from the very person who is intended or desired should pay it. Indirect taxes are those which are demanded from the one person in the expectation and an intention that we shall identify him at the expenses of another. Impact of tax and tax incidence. The term impact is used to express the immediate result of a result of or original imposition of the tax. The impact of a tax is on the person on whom it is imposed first. The term incidence refers to the location of a ultimate or the direct money burden of the tax as such. Signifies the settlement of the tax burden on the ultimate taxpayer. Incidence emerges when the tax finally settles or comes to rest on the person who bears it. Impact refers to the initial burden of the tax, while incidence refers to the ultimate burden of the tax. Impact is at the point of imposition, incidence occurs at the point of settlement. Various direct taxes, income tax. It is a tax levied directly on the income of the people by the central government. The government imposes this tax on taxable income of all persons who are individual Hindu undivided families, HUFs, companies, firms, LLPs, limited liability partnership, association of person, local authority, and any other artificial judicial person. It was first levied in the year 1860s by Sir James Wilson in in independent India. It was levied for the first time in the year 1950. It is not levied on agriculture income. The rate of direct tax increases with increase in income. Therefore, it is a progressive tax. Corporate tax. It is levied on the profit of the companies or corporations for the year 2019-20. The corporate tax rate is 30%. It is the largest source of revenue of the central government, covering about 18% of the total revenue. Wealth tax. This tax is levied on the net wealth of the individuals, Hindu undivided families, HUFs, and joint stock companies. It is a minor source of revenue for the government, primarily imposed to reduce concentration of wealth in the society. It was imposed in India with effect from 1st April 1957 on the recommendation of Professor Kaldor. Agriculture, land, houses in rural areas, properties of religious trust, etc., have been exempted from this tax. Gift tax. This tax is imposed by the central government on all donations and gifts over and above the prescribed limits to the family members. This tax was implemented in India in the year 1958 on the recommendation of Professor Kaldo. Religious and educational organizations are exempted from this tax. From the year 1990-91, the liability for payment of this tax lies with the receiver of the gift. Other property tax. This tax was implemented in India in the year 1953. This tax was levied on the property of an individual after his death. The burden of payment of this tax lied with the legal heirs of the deceased. This tax was discontinued from the year 1985 to 86. Interest tax. This tax was levied on the lump sum payment of interest on loans and advances by the commercial banks. However, this tax was highly unpopular and adversely affected the banking habits of the people, hence was discontinued from 1985. Merits of direct tax. Elasticity. Direct tax has elasticity. Whenever the government needs more revenue, it may raise the rate of direct taxes. In case the government desires to give relief to the taxpayer, it may reduce the rate of taxes. It can be varied according to the needs of the government and changes in the income of the people. Certainty. The canon of certainty is perfectly embodied in direct taxation. In case of direct taxes, the taxpayer is certain about the amount, time, and manner of payment of the tax. According to Adam Smith, the tax which each individual is bound to pay ought to be certain and not arbitrary. Economical. There is no difficulty in collecting direct tax because these taxes are fixed. Instead of levying a number of direct taxes, a substantial revenue can be generated by levying one, three to four direct taxes. Their collection charges are also low. Hence, it is called an economical tax. Productivity. A good tax must satisfy the canon of productivity. Productivity implies more revenue, returns, and regularity and stability of revenue quantity. As revenue from direct taxes automatically increases or decreases with the change in the national income or wealth of the country. Therefore, direct taxes are productive. Equity and fairness. As the government charges more taxes from the people who can afford them and spend that money on the poor, a step in the right direction is made. Furthermore, it also positively affects the social binding of different groups of people that are divided on the basis of income and wealth. Lower income groups are also exempted from paying tax. It means larger amount of tax from the rich than from the poor. This is called progressive taxes, and direct taxes are imposed with the purpose of bringing equitable distribution of wealth, income, and property, and to reduce the gap between rich and poor. Social consciousness. Direct taxes tend to improve the civic consciousness of the taxpayer. Direct taxes have an educative value as they create a civic sense among the taxpayers. When the people are fully aware of the payment of taxes, they are also conscious of the way the government spends the money. They resent unproductive or wasteful expenditure. As a result, the government become careful in its expenditure. Direct relation. Chances of tax evasion are also minimized in direct taxes when they are collected at sources. It is collected from individual directly, therefore the tax directly reaches the government. Demerits of direct tax. Unpopularity. Such taxes are not very popular because the people have to bear the burden of taxes directly. That is why when the rate of a direct tax is raised, most people express their resentment against the government. Arbitrary. The nature and base of direct taxes are arbitrarily decided by the exchequer. The finance minister uses his own value judgment in determining the taxation potential of the taxpayer. The interest of taxpayer is not considered. Unsympathetic. Great disadvantage of the direct taxes is that they are usually not in accordance with the canon of convenience. In order to submit the tax, a person has to undergo several formalities and procedures. Such inconvenience is also one of the important factors which promotes tax evasion. Tax evasion. Probably the biggest disadvantage of direct taxes is that it leads to tax evasion and corruption in a society. If the system is not watertight, there is always a chance of tax evasion. By minimizing the law and using stable, subtle techniques. Subtle techniques. Moreover, the more blatant way is to suppress the profits by showing wrong statements of profits, which reduces the tax rate imposed on the person. Not applicable at all. Direct taxes are generally narrow ways, therefore, a large section of masses remains untouched, and to that extent, they fail to achieve their objective of promoting civic sense among the citizens. Discourage savings and investment. Direct taxes, if they are excessive, may discourage savings and disinvestment. Many business ventures are not undertaken on the ground that a large part of the income earned will have to be given to the government in the form of taxes. Indirect tax. They are those taxes which have their primary burden of or impact on one person, but that person succeeds in shifting his burden on to others. Consequently, the final or the real burden of the taxes or the incidence has to be borne by a third person. In India, excise duty, GST, etc. are the examples of indirect taxes. Various indirect taxes. Central excise duty. Central excise duty is imposed by the central government on the goods produced within the country except certain goods, one on which state governments are empowered to impose tax. These goods include liquor, drugs, etc. Custom duty. This duty is imposed on commodities which are to be imported or exported from India. In other words, when goods cross the political boundary of a country or they come from other countries, custom duty is imposed. Service tax. Comparatively a new concept in India, service tax is a tax imposed on the person who avail any specified service. This tax was introduced in India in 1994-95. Value-added tax (VAT). This tax was introduced in India in April 2005. It was levied in the course of intra-state sales. It is levied on the value added to a good and therefore helps to prevent repetition and helps to check inflation. It also helps to check tax evasion. Goods and Services Tax (GST). Government of India implemented GST from 1st July 2017. It converts the country into a unified market, replacing most indirect taxes with one tax. It is levied both on goods and services. It is an integrated scheme of taxation that does not discriminate between goods and services, and it is a part of the proposed tax reforms that center on evolving an efficient and harmonized consumption tax system in the country. Two components, one levied by the center, referred to an central GST, and the other levied by the states, referred to as state GST, are part of GST. Rates for which would be prescribed appropriately as of 2019 to 20. The rates are 0%, 5%, 12%, 15%, and 28%. The empowered committee has decided to adopt a two-rate structure, a lower rate for necessary items and goods of basic importance and a standard rate for goods in general. There will also be a special rate for precious metals and a list of exempted items. The GST is levied in India at the following levels: Central GST, CGST. Under the CGST, there is a provision to impose tax on the supply of goods and services by the central government. Earlier, central excise drug and toilets construction excise duties on the taxes imposed by the central government. Goods of special importance, additional duty of custom duty known under CVD, special additional duty of custom duty, ACD, SAT, service tax, and gratuity such as related to the supply of goods or services were separate taxes. All this now included in CGST. State GST, SGST. Taxes imposed and collected by the state government on goods and services are levied under state GST system. Earlier, state government collected VAT, purchase tax, entry tax, entertainment tax, advertisement tax, including state excise and surcharge related to state tax and imposition, lottery taxes, tax on speculation and gambling. All these taxes are now included in SGST. Integrated GST, IGST, state indemnification. The proposed goods and services tax provides an integrated GST, IGST levied on international commodities and services. It is imposed and recovered by the central government. The amount of taxes received under this tax is distributed to the state for the loss of revenue generated to the states. Union Territory GST, UTGST. Arrangement or provision under the UTGST and tax system is for the Union Territory where they do not have their own legislative assemblies, such as Andaman and Nicobar Islands, Andaman and Diu and Dadar and Nagar Haveli, etc. Thus, Union Territories have the provision of imposes and collects taxes by the central government. Taxes subsumed in GST, central taxes replaced by GST, central excise duty, additional duties of excise and customs, special additional duty of customs, add service tax and cesses and surcharge on supply of goods and services. State taxes subsumed in the GST, VAT, central sales tax, purchase tax, luxury tax, entry tax, entertainment tax, taxes on advertisement, lotteries, betting, gambling, and state sales and surcharges. Taxes not included in GST. Taxes that are not included in any of form of GST are taxes levied on alcohol, real estate, crude oil, petrol, natural gas, and the fuel for turbine. All these items are out of GST provision are the current taxation system will be applicable on them. Modes of indirect taxes, economical. Indirect taxes are not difficult to collect as they are collected from the farms and traders who pass them on to the buyers in the form of higher prices of goods. The collection of tax is possible without any specific expenditure. There are also no administrative problems. Broad base. The indirect taxes have a wide coverage. Majority of the products or services are subject to indirect taxes. The consumers or users of such products and services have to pay them. Elastic. Some of the indirect taxes are elastic in nature. When government feels it's necessary to increase its revenues, it increases these taxes. Checks the consumption of harmful goods. Indirect taxes can check the consumption of harmful or socially undesirable products. The government can decode to tax such goods and at a higher rate. This will increase their price and thus their demand will be adversely affected. tax evasion is difficult. Indirect taxes have inbuilt safeguards against tax evasion. The indirect taxes are billed by customers. The sellers have to collect it and remit it to the government. Fair. Indirect taxes are paid by all classes of people, and so they are broad based. Poor people may be out of the net of the income tax, but they pay indirect taxes while buying goods. Convenient. People have to pay these taxes bit by bit. This piecemeal payment of an indirect tax makes it easier for the taxpayers. Social welfare. The indirect taxes promote social welfare. The amount collected by way of taxes is utilized by the government for social welfare activities, including education, health, and family welfare. Demerits of indirect taxes: high cost of collection. Indirect tax fails to satisfy the principle of economy. The government has to establish machinery to administer indirect taxes. Therefore, cost of tax collection per unit of revenue raised is usually higher with respect to most of the indirect taxes. Lack of social consciousness. Indirect taxes fail to create any social consciousness as the taxpayer do not feel the burden of the taxes they pay. Uncertainty. Indirect taxes are uncertain. Taxes on commodities with classic elastic demand are particularly uncertain, since quantity demanded will fall greatly as prices go up due to the imposition of tax. In fact, a higher rate of tax on a particular commodity may not bring in more revenue, increases income inequalities. Generally, the indirect taxes are regressive in nature. The rich and the poor have to pay the same rate of indirect taxes on certain commodities of mass consumption. This may contribute to the increase in income disparities among the rich and the poor, affect consumptions. Indirect taxes affects consumption of certain products. For instance, a higher rate of duty on certain products such as consumers durables may restrict the use of such products. The consumers of the middle class group may delay their purchase or they may not buy at all. The reduction in consumption affects the investment and production activities, which results in affecting the rate of economic growth. Possibility of tax evasion. There is a possibility of evasion as some customers may not pay indirect taxes with the support of sellers. For instance, individuals may purchase items without a bill, and therefore may not pay GST, or may avail a service without a bill and therefore may again evade GST. Inflationary. The indirect taxes are inflationary in nature. The tax charged on goods and services increase their prices. Therefore, these taxes are inflationary. Fall in consumption and employment. Indirect taxes are included in prices, so indirect taxes raise the prices of commodities. The consumption of lower income groups is bound to fall because of rise in prices of commodities. Fall in the consumption of essential commodities worsen health and efficiency of the masses. Also, it leads to decline in employment. Progressive tax. A progressive tax is that is which the rate of tax increases with the increase in the income. The higher the level of income, the higher the tax will be, and vice versa. Under this type of tax structure, with increasing income, the tax liability of a taxpayer increases not only in absolute terms but also as a proportionate of his income. Merits of progressive taxes. Principle of equality. Progressive taxation justifies the principle of equality. It secures equality in sacrifice and leads to justice in the distribution of tax burden. Since the marginal utility of money to a rich person is less than a person or a poor person, the rich should be taxed at a higher rate than the poor. In progressive taxation, higher income groups tend to contribute more in the form of taxes. Equal distribution of income. It is more just and impartial, as it aims to achieve a reduction in inequality with respect to earnings of the citizens in an economy. It reduces inequality in the distribution of income. In this type of taxation, the rich contributes more towards tax revenues as they have higher ability to pay. Economical. It is inexpensive to collect progressive taxes, as the cost of collection of taxes does not increase in the same proportion as the rate of tax increases with which makes the collection of progressive tax economical. Elastic. The revenue collection of a government can be augmented by increasing the tax rate. Its rate can be altered as per the changing needs of the country, thereby displaying its elasticity. Therefore, the government can increase its revenue collection considerably. Opportunities of employment. The marginal propensity to consume increases as the wealth shifts from the rich to the poor by imposing progressive taxation. Hence, it leads to more investment and creates opportunities for employment. Helps to check recession. Progressive taxation helps protect people during a recession because if their income drops, they fall into a lower tax brackets. This means they will owe less money to the government. The merits of progressive taxes uncertain. Progressive taxation is arbitrary and uncertain. There is no guiding framework according to which tax refers to rates are fixed. There are uncertainty as to the rate at which taxes should increase. Tax evasion. It encourages high income earners to hide their wealth from the government. There is a large scope for tax evasion in a case of progressive taxation. This is done by the furnishing false declaration and filing false assessment. Loss of revenue. Tax evasion leads to false assessment in the tax returns from leading to loss of revenue, hampers growth. It will adversely affect production and discourage capital formation. It will hamper the growth of trade and industry. According to Professor J. A. Smith, to tax the higher income at higher percentage than smaller is to lay a tax on industry and economy. Socialism. As the taxes are levied on the rich and consequently redistributed among poor through government aided programs, this result in socialism. And as we know, socialism is not a desired economical structure in the present times. Invasion of individual rights. Progressive taxes may be considered as invasion to individual rights as they are punished for their success. Proportional taxes. A proportional tax is one in which the rate of tax remains the same irrespective of the level of income. Here, the same percentage of tax is levied on all income groups. The tax amount is simply calculated by multiplying the tax base with the tax rate. The tax structure of any economy is termed as proportional if the tax liability of a taxpayer increases in the same proportion as the increases in his income. Merits of proportional tax is simple. Proportional tax is simple to understand by both tax authorities as well as tax paying individual, which in turn leads to better implementation by the tax authorities and acceptance by the paying individuals. Equity. The first and foremost advantage of proportional tax is that all people pay taxes at the same rate. This develops a feeling of equity among the taxpayers. Reduce tax evasion. Another benefits of proportional tax is that it reduces tax evasion because higher income is also taxed at the same rate. So, in a way, proportional tax leads to less tax leakage from the system. Convenient. It is easy for the taxpayer. Calculation of tax is very convenient in this taxation system. Certainty. The rate of tax is fixed and certain. There are no multiple tax rates for different income slabs, so it is easy to estimate the amount of tax payable. Demerits of proportional taxes against the principle of justice. The biggest drawback of proportional tax is the large section of the society, middle and lower class, feel cheated because, according to them, those who have more money should also pay more tax. But since this system keeps tax rate same for all, there is frustration and anger among the middle and poor class people of the country. It is against the principle of justice. Increase in inequality. Another demerits of direct tax is that increase in inequality. Another demerits of proportional tax is that since rich and poor and taxed at the same rate, it leads to a huge gap between the rich and the poor, leading to anger, frustration, and in the worst case scenario, may even lead to the revolt by middle and poor class against affluent people and government of the country. Less collection. Another disadvantage of proportional tax is that government receives less tax because tax rate has to be kept low so as to appease poor and middle class, which in turn leads to loss of revenue for the government of the country. Unpractical. Currently, proportional taxation is not working anywhere in the world. It is not practical in general life, so it is not acceptable. Low production. It will adversely affect the production and discourage capital formation. It is not fit for promoting economic growth. Regressive, non-progressive taxes. Under this type of tax structure, rate of taxation increases with the increase in income up to a limit, but the rate of tax remains the same after that limit. In this taxation, the higher the income of the taxpayer, the smaller is the proportion of income he contributes to the government in the form of taxes. In regressive taxation, the tax rate declines as income increases. This type of taxation is against the objective of welfare state in modern time. Merits of regressive taxes convenient. These taxes are paid in the form of price of commodities. People pay these taxes when they buy commodities. Increase in investment. Investment level will get increased as people with high income will pay less tax, and the savings level will increase and will be channelized as investment. The aggregate demand increases, which encourages more investment. No evasion. The poor section of the economy is not in a position to evade these taxes. Limits of regressive taxes. Unjust method. The tax burden decreases with increase of income. The incidence of tax is greater on poor than on the rich. Therefore, it is an unjust method of taxation. Unemployment. Unemployment level increases as the poor might not be willing to work as the major part of the earnings are to be paid as tax. Non-productive. These taxes are usually implemented on low priced commodities. These commodities are consumed by low income consumers. There is a discouragement in the production of these commodities. Effects of taxation. According to Dalton, the effect of taxation on production and growth may be analyzed with reference to capacity to work, save and invest. They will to work, save and invest. An alternative way of analyzing these effects would be to split them up to on half into shift in the allocation of existing productive a change in the supply of these productive resources and use them as manifestation of the capacity and will to work, save and invest. It is noteworthy that different segments of these effects and highly interdependent, and it is not for analytical simplicity and comprehension that they are considered slightly or in groups. Theories related to taxation. Benefits received theory. According to this theory, citizens should be asked to pay taxes in proportion to the benefits they receive from the services rendered by the government. This theory is based on the assumptions that there is some quid pro quo between the taxpayers and the government. The government provides services and social goods to the taxpayers and they pay tax to the government. This theory is applied when road tax is collected from vehicle owners. However, this theory has been criticized on the following grounds. It is difficult to measure the benefits received by an individual. Most of the government expenditure is incurred on common individual benefits, so division of benefits of government expenditure is not possible. It is against the very notion of a tax. Ability to pay theory. According to this theory, individuals should be asked to pay taxes according to their ability, as the rich have a greater ability to pay. Therefore, they should be taxed at higher rates so that the burden of a tax falling on various persons remains the same. This theory has the following approaches. Subjective approach. This approach is based on the sacrifice of utility while paying a tax. The following three principles of sacrifice have been put forward by various authors. Principle of equal absolute sacrifice. According to this principle, the tax burden in terms of utility sacrifice should be the same for all taxpayers. Principle of equal proportional sacrifice. According to this principle, every person should be made to pay so much tax that the sacrifice of utility as a proportion of his income is the same for all taxpayers. Principle of equal marginal sacrifice. According to this principle, tax burden should be apportioned among various individuals that marginal sacrifice of each person paying the tax should be the same. This principle seeks to minimize the aggregate sacrifice of the society as a whole. This principle has been recommended by Edgeworth, Pigou, and Musgrave. Objective approach. This approach considers what should be the objective base of taxation which measures ability to pay correctly. According to this approach, income and wealth are considered to be appropriate measures of the ability to pay. Non-tax revenue. Non-tax revenue are those receipts which are received from sources other than taxes like fees, fines, etc. Some of the non-tax receipts are as follows: fee, license, and permit. Fee is charged for government services like land registration fee, birth and death registration fee, passport fee, court fee, etc. License and permit are the amount that the government charges for allowing individual to perform a given job. Exceed. It refers to income of state from property which has to claimant and here. In such a case, state has the right over such property. Special assessment. It is that payment which is made by the owners of those properties whose value has appreciated due to development activities of the government. Fines and penalties. Payment which government receives from the low brackets. Income from public expenditure. The profits earned by the government from public sector enterprises. Administrative income. Administrative income are those receipts which arise because of the administrative functions of the government. Government formulates the rules and regulations to maintain the administrative and law and order. Government also imposes penalty of those who violates the rules. The income received through administrative work is called administrative income. Funds created by the government. Consolidated fund. All the revenue received by the government, but be it is tax revenue, non-tax revenue, or loans are credited to this fund. Contingency fund. The money in this fund is used for payment of such expenses which cannot be delayed. Public account. The government cannot use the money credited to this account. Public expenditure. It refers to the expenses of public authorities, central, state, and local government in a federation for the satisfaction of collective needs of the citizens, or for promotion of economic and social welfare. Public expenditure can be defined as the expenditure incurred by public authorities like central, state, and local governments to satisfy the collective social wants of the people is known as public expenditure. Classification of public expenditure. Revenue expenditure. Revenue expenditure is a current or consumption expenditure incurred on civil administration, political jails, and judiciary, defense forces, public health, and education. This expenditure is of recurrent type, which is incurred year after year. Say, capital expenditure. Capital expenditure or capital expense is an expense where the benefits continues over a long period rather than being exhausted in a short period. Such expenditure is of a non-recurring nature and results in an acquisition of permanent assets. For example, expenditure on building, power plants, highways, ports, etc. Other classification of public expenditure. The central government adopted a new classification of public expenditure from 1987 to 88 budget, which abolished in 2017. Under this new classification, all public expenditure is classified into non-plan expenditure and plan expenditure. Non-plan expenditure. Non-plan expenditure of government is further divided into revenue expenditure and capital expenditure. Revenue expenditure is financed out of revenue receipts, both tax revenue and non-tax revenue. Under the revenue expenditure, we include interest payments, defense revenue expenditure, major subsidies, food, fertilizers, and export promotion. Other subsidies, debit relief to farmers, postal and deficit policies, pensions, other general services, organs of state tax collection, external affairs, etc. Social services, education, health, broadcasting, etc., economic services, agriculture, industry, power, transport, communication, science and technology, etc., grants to states and union territories, and grants to foreign governments. Capital non-planned expenditure includes such items as defense capital expenditure, loans to public enterprises, loans to states and union territories, and loans to foreign governments. Planned expenditure. There, the second major items of central government expenditure is planned expenditure, which is composed of central plans such as on agriculture, rural development, irrigation and flood control, energy, industry and minerals, transport, communication, science and technology, and environment, social service, and other central assistance for plans of the state and union territories. Effect of public expenditure on production. Public expenditure has a great bearing on economic development and social welfare of the country. The effect of expenditure on production can be examined with reference to its effects on ability and willingness to work, save, and invest, and on diversion of resources. These are as follows: ability to work, save, and invest. Socially desirable public expenditure increases community productive capacity. Expenditure on education, health, communication, etc., increases people's productivity at work, and therefore their incomes. With rise in income, savings also increases, and this in tune has a beneficial effect on investment and capital formation. Willingness to work, save, and invest. Public expenditure sometimes has adverse effect on people's willingness to work and save. Government expenditure on social security facilitates may bring such unfavorable effects. Government spends a considerably portions of its income towards provision of social security benefits such as unemployment allowance, old age pension, insurance benefits, sickness benefits, medical benefits, etc. Such benefits reduces the desire to work. In other words, they are as a disincentive to work. Effect on allocation of resources among defined industries and trade. Many a times the government expenditure proves to be an effective instrument to encourage investment on a particular industry. Example, if a government decides to promote exports, it provides benefits like subsidies, tax benefits to attract investment towards such industries. Similarly, government can also promote a particular region by providing various incentives for those who make investment in that region. Other effects of public expenditure. Effect on economic stability. Economic instability may translate into depression, recession, and inflation. Public expenditure is a mechanism to control instability. These states of recession and depression are particularly dangerous for restricting the pace of growth. Economic Keynes and advocated public expenditure as a better device to raise the level of effective demand and to get out of depression. Public expenditure is also useful in controlling inflation and deflation. Expansion of public expenditure during deflation and reduction of public expenditure during inflation controls money supply and brings price stability. Effect on economic growth. The goals of planning is effectively realized through government expenditure. The government distributes funds for the growth of various sectors like agriculture, industry, transport, communication, education, energy, health, exports, imports, so as to achieve impressive growth. Government expenditure has been very helpful in maintaining balanced economic growth. Government takes a keen interest in allocating more resources for development of backward regions. Such efforts reduce regional disparity and promote balanced economic growth. Public expenditure and deflation. During deflation, the prices of commodities tend to fall. Accordingly, there is a fall in production and employment. Both the producers and the consumers become pessimistic. Producers decrease output because of the lack of demand. Consumers, hoping for a further fall in prices, suspend their existing consumption needs. Accordingly, reduction in demand is compounded. As a consequence, the various circle of reduced demand, reduced production, and reduced employment goes on. According to Keynes, during depression, the government should plan for a comprehensive increase in public expenditure. Undue influence of public expenditure. Assistance to unnecessary industries. Public expenditure is misused when it is used to fund unnecessary industries. Financial assistance given to industries which are not important will be useless. Also, this interrupts the growth of nation. The tendency of political influence. Public expenditure is misused when it is used in political influence. It is not a good sign for growth of a nation. Special benefits of special class. Public expenditure is misused when it is used for a special class only. It is harmful for the nation and also harmful for the society. Importance of public expenditure. In the 1930s, James Keynes advocated the importance of public expenditure. The modern state is described as the welfare state. As a result, the activities of the modern government have widened enormously. Without government support and backing, a poor country cannot make huge investments to bring about desired change in the economic base of a country. Public expenditure is considered as an important tool as fiscal policy. Public expenditure creates and increases the scope of employment opportunities. At the time of depression, public expenditure is used as an important fiscal instrument to bring about an equitable distribution of income and wealth. Thus, public expenditure has both economic and social objectives. It is necessary to ensure that the government's expenditure is made solely in the interest of public and does not serve any individual's interest or that of any political party or a group of persons. Causes of increase in public expenditure. Economic development. Modern government has a great role to play in shaping an economy. Private capitalists are utterly incapable of financing economic development of a country. This incapacity of the private sector has forced modern governments to invest in various sectors so that economic development occurs. Economic development is largely conditioned by the availability of economic infrastructure. Only by building building of economic infrastructure, road transport, electricity, etc., the structure of an economy can be improved. Obviously, for financing these activities, government spends money. Resource mobilization and ability to finance. When the government innovates more and more methods of taxation and resource mobilization, its ability to finance public expenditure increases and the size of the public in expenditure grows. Public sector outlays could be increased by more taxation, yield, public debt, foreign aid, and deficit financing. Welfare state. In the 19th century, state was a police state, while in 20th and 21st centuries, modern state is a welfare state. Even in a capitalist framework, socialistic principle cannot altogether discarded. Government spends money to provide various social security benefits. Social sectors like health, education, etc., receive a special treatment under the government patronage. It adds up not only social infrastructure but also economic infrastructure in the form of transport, electricity, etc. All this results in an increase in public expenditure. Public debt and its management. Public debt is very important source of finance for the government. It refers to the government borrowing from individuals, financial institutions, organizations, and foreign countries. When the government expenditure is not made by the revenue collected from through taxes and other sources, then government resorts to borrowing. It may be raised internally or externally. The instruments of public debt take the form of government bonds or securities of various kinds. In short, public debt refers to obligations of government, particularly those evidenced by securities to pay sums to the holders at some future date. It implies the stock of borrowing as opposed to the annual increase in the total borrowing represented by the government deficit. According to Philip E. Taylor, public debt is a debt in the form of promises by the Treasury to pay to the holders of these promises a principal sum, and in most instances interest on that principal. Objective of public debt. Public debt is the debt owned by the government and is one of the method of financing government operation. The main objective of government might encourage debt are as follow: to meet budget deficit, the government may borrow because its current expenditure is more than the current revenue. To finance war and natural calamities, when there are wars or natural calamities, then government raises debit to meet the expenditure. To finance development plans, the government raises debit to finance its developmental plans. To finance external deficit, to cover the balance of payments deficits, the underdeveloped countries raises external debit. Types of public debit হচ্ছে গিয়ে there are mainly six types of public debit which are as follows: internal and external debit. Internal debit refers to the public loans borrowed from within the country. The internal borrowings include market loans, bonds, treasury bills, advances, etc. It may be voluntary or compulsory. It imply a retribution of income and wealth within the country, and therefore it has no direct money burden. External debit refers to that borrowing which government borrows from abroad. It employs or multilateral bilateral borrowings, loans from the World Bank, Asian Development Bank, etc. These borrowings are usually voluntary, and it involves a transfer of resources from foreign countries to domestic countries. But when interest and principal amount are being paid and transfer of resources take place in reverse direction. Marketable and non-marketable debit. When debit can be sold by the existing holders to others, it is called marketable debit. Whereas non-marketable debit are those which have been issued in favor of particular debit holders only and cannot be sold to others. Productive and unproductive debit. Productive debit are those debit which are used by the government directly for productive purpose or to add to the productive capacity of the economy. These are normally long term in nature and utilized on developmental activities such as infrastructure development like roadways, railways, airports, seaports, power generation, telecommunication, etc. This type of debit are liquidating in nature, which means the principal amount and interest are normally paid out of the revenues generated from the project to which the loans were utilized. Whereas unproductive debit imply that debit which does not yield any income. Debits utilized for transfer payments in the form of subsidies, old age pension, special incentives to weaker sections, etc. Their net burden on community and governments resort to taxation for their servicing and repayment. Redeemable and irredeemable debit. Redeemable debit are those debit which government promises to pay off at some future date. The government has to make arrangement to repay the principal and interest on due date because of the maturity period of fixed. Whereas irredeemable debit are those debit in which no promises are made by the government regarding their exact date of repayment. The government may pay interest regularly, and it has no fixed maturity period. Funded and unfunded debit. Funded debit is normally obtained on long term basis. It is that public debit for the payment of which the government established a separate fund. It comprises of securities which are marketable. The interest must be paid regularly. The government has the option to repay the principal if the market conditions are favorable. Government may repay it before maturity. Whereas unfunded debit are short term loans and are also called floating debit. It is encouraged to meet temporary needs of the government, and their rate of interest is low. There is no special fund created to repay this debit. Compulsory and voluntary debit. Normally, the government does not obtain funds through compulsory means. The government may obtain such loans from banks, financial institutions, and large corporate firms at times of war or major disaster only when it is not possible to obtain voluntary debit. Whereas voluntary debit are those loans which are voluntary in nature. It may be obtained in the form of market loans, bonds, etc. The rate of interest is normally higher than that of compulsory debit. People invest in voluntary debit from the point of view of liquidity and profitability. Public debit in India. The external debit of India is the total debit of the country which owes to foreign creditors. The debitor can be the union government, state government, corporations, or citizens of the India. The debit includes money owed to private commercial banks, foreign governments, or international financial institutions such as the International Monetary Fund (IMF) and World Bank. India's external debit data is published quarterly with a lag of 1 quarter. Statistics for the first 2 quarters of the calendar year are compiled and published by the Reserve Bank of India. Data for the last 2 quarters is compiled and published by the Ministry of Finance. Sources of public debit. So there are mainly two sources of public debit: internal and external. Internal debit sources. Now, it refers to the government loans floated in the capital markets within the political boundaries of the country. The main sources of internal borrowing are individuals, banking and non-banking institutions, central bank, etc. Tools of internal debit: market loans having a maturity period of 12 months more. Treasury bill. Treasury bill is a major source of short-term funds for the government to bridge the gap between revenue and expenditure. Securities against small savings under the new accounting system of National Small Saving Funds (NSSF). A substantial part of small savings have been converted into central government securities, bonds, and expired loans. It comprises balance of expired loans, gold bonds, and compensation, and others such as national rural development bonds, central investment bonds. External debit sources. It refers to the government loans floated in foreign capital market. The main sources are foreign governments, international agencies like IMF, international finance corporations, international development association, etc. Effect of public debit. There are two types of effects of public debit: positive and negative effects. Positive effects of public debit: mobilization of resources with the help of borrowings. Government can easily make various types of plans to mobilize the resources efficiently. Increase in the productive capacity. With increase in borrowing, productive capacity of a country can easily be increased. Borrowing is very helpful in using capital intensive techniques to increase the productive capacity of a country. For investments promotion, public borrowing helps to promote investments. Borrowing funds can be utilized for strengthening infrastructure and promoting economic development of country. Developmental expenditure. Public borrowings can be used to meet the developmental expenditure like roads, communication system, railways, telecom, finance, etc. Generating foreign exchange. Borrowing in the form of foreign exchange can be used to meet the developmental activities. For developmental purposes, the government it tries to acquire money, capital, raw material from foreign countries. It can then only be possible if we have stock of foreign exchange with us. Okay, negative effects of public debit. Effect on distribution of income. Public debit affects the distribution of income among the people. Government raises loans from higher income group people and the return of it is also given to them only. This will create disparity among people and becomes richer and poor becomes poorer. Negative impact on savings and investment. When the government imposes new taxes on the people for the repayment of loans, it will adversely affect the rate of savings and investment. Increase in inflation. With increase in the public borrowings, money supply in the market increases, which increases the price of the commodities. Burden of public debit. Direct money burden. It refers to the amount of money to be raised to meet the revenue requirement in the form of interest. In case of internal public debit, there is no direct money burden, because in this case money changes hands only. But in case of external debit, money burden is heavy. Indirect money burden. When government raises debit, it results in expansion of credit in the country. As a consequence, the prices of goods and services rise, imposing additional burden on the society. Direct real burden. It strains and stresses taxpayers, which reduces the economic welfare. Indirect real burden. When the government imposes taxes to repay loans and interest, it discourages the willingness of the taxpayers to work more and save more. Thus, it adversely affects the production in a country, and the indirect real burden of a tax will be heavy. Principle of public debit management. Public debit must be minimized for the instead interest cost of servicing. According to this principle, in order to minimize the interest cost, the government must be in a position to create and redeem public debits. If the interest cost is minimum, the government will have to impose smaller amount of additional taxes and vice versa. Therefore, the smaller amount of taxes will have less adverse effects on the various economic intensives, i.e., the willingness to work more and save more, satisfaction of the needs and investors. The principle, thus, this principle states that the public debits should be managed in such a way that the needs of the investors with regard to the types of government securities and the terms of issues are satisfied. For instance, if government desires to fund its short-term debit into a long-term debit, it will have to offer attractive terms on the long-term securities, such as higher interest rates on them, or the government may offer to the security holders to convert long-term securities into cash without any loss for the purchase of new securities issued by the government. In that case, the general liquidity of the public debit remains more or less the same. Funding of short-term debit into long-term debit. In this principle, the public management should help to fund as much of the short-term debit into long-term debit as possible. In this case, the funding of operations should be done without distributing. The economic stability must be coordinated with the fiscal and monetary policy. It is essential to establish the coordination of public debit policy with the fiscal and monetary policy to maintain economic stability and to promote economic growth. In other words, the allocation of responsibilities among the Ministry of Finance, the central bank of a bank, or a separate debit management agency for debit management policy advice, and for undertaking primary debit issues, secondary market arrangements, depository facilities, and clearing and settlement arrangement for trade in government securities should be publicly closed. Maturity distribution and kinds of debit holders. If the major proportion of the total debit consists of short-term debit and major proportions of the total debit is held by banks, then there can be a high degree of liquidity which causes an inflationary pressure at a time when an anti-inflationary policy may be desirable.